going. Good afternoon, everybody. Trust that you and your loved ones are safe during these interesting times. I'm Yasmin Omari, Executive Director of the Perl Initiative, and I'd like to thank you for joining us today for our webinar on combating corruption, the importance of robust due diligence, being held as part of our anti-corruption best practices program. This is the first in a series we are holding in collaboration with the GoodCorporation. And we've got a series of 8 webinars being held over the next 2 months, so around interesting topics of anti-corruption. So please do stay tuned and follow those closely if this is an area you're interested in. Before I delve further into the theme for today's webinar, I'd like to take this opportunity to provide a brief overview of the Perl Initiative for those of you we are new to. Developed in cooperation with the United Nations Office of Partnerships, the Perl Initiative was launched in September 2010 at the United Nations headquarters in New York. The Perl Initiative is the region's leading independent non-profit organisation committed to supporting the private sector in proactively taking a lead to adopting higher standards of corporate governance, transparency and accountability in order to enhance business competitiveness and value creation. With its growing network of partner companies, the Perl Initiative is committed to driving collective action, exhibiting decisive leadership and sharing of knowledge and experience to positively influence regional businesses and student communities. Today's webinar, third-party due diligence hasn't always been amongst the first priorities considered by businesses implementing adequate procedures to tackle bribery and corruption. As a consequence, many organisations struggle to put in place effective and proportionate due diligence processes aligned to their markets. We've seen that every day brings new reports of companies falling foul of anti-bribery and corruption rules and regulations, money laundering, fraud, kickbacks and other inducements to win contracts or gain favours. Despite laws prohibiting bribery in most countries around the world, these unethical and often dangerous behaviours persist and show little sign of relenting. As a result, governments and regulators around the world are intensifying their efforts to compel organisations to mitigate these risks by implementing robust anti-bribery and corruption procedures. Leveraging the expertise and knowledge from our guest speakers here with us today, we aim to discuss assessments showing how well companies are meeting their due diligence obligations, and we'll look into where due diligence most often fail and some of the best practices in due diligence. I'd like to introduce you our speakers for today, who will be leading today's session. Joining us from the UAE is Mohammed Dawood, a strategic leader and a seasoned professional with over 25 years experience in the banking and finance sector in the US, Europe, Middle East and Africa, focusing on governance, risk and compliance for over 18 years. Mohammed's extensive experience focuses on various domains of risk strategy, effective corporate governance and reputational risk. He has broadened his international leadership experience across both business and technology management, including strategy consulting, business transformation, operations and product. With his expertise in fintech and regtech solutions, Mohammed connects data intelligence and helps in identifying, assessing and monitoring regulatory and third-party risks. Based on his experience, Mohammed has substantial knowledge in anti-money laundering, combating financing terrorism, and active in deploying anti-bribery and corruption programs. Thank you, Mohammed, for joining us today and supporting us in this webinar. The second panelist for today, joining us from London, is Michael Pollitt, Senior Business Ethics Consultant at GoodCorporation. A regular speaker and trainer on business ethics and issues of ethical company culture, Michael has conducted business ethics training sessions and webinars across the MENA region, including most recently a day-long workshop on business ethics and compliance with clients and potential clients of the European Bank in Cairo. His experience in the MENA region also includes work in Algeria and Saudi Arabia. Before joining GoodCorporation, Michael worked as a lead researcher and advisor on business ethics to the chair of the Modern Slavery Bill Evidence Review at the UK Parliament. While in Parliament, Michael worked with a number of high-profile UK politicians, government ministers and government suppliers, focusing on business ethics in general and human rights in particular. Thank you, Michael, once again for supporting us on this session, and we look forward to having your participation on the upcoming series.
Absolute pleasure.
And Yasmin, you need to add that Michael speaks very good French and Arabic. I was surprised.
Michael is a trilingual ethics advisor. Does that work?
That works for me.
All right. I won't test you, Michael, don't worry. In relation to today's session, the panel is set up to be a conversation between Michael and Mohammed, and we will set aside 15 minutes at the end of the discussion for questions from yourselves as participants. As with all our webinars, we like them to be as interactive as possible, and we invite you to ask any questions you may have pertaining to the topic during the session using the platform's Q&A tool. The panelists will take the last 15 minutes of the session to answer them, so they may not address them directly or immediately, but they will be addressed at some point during the session. I will hand over to Michael, who will be kicking off the session with an introduction into the research of the GoodCorporation, to be followed by a conversation with Mohammed. Thank you once again, Michael and Mohammed, and thank you all for joining this webinar. Over to you.
Thanks very much, Yasmin. So I'm not going to talk for very long because we want this to be very interactive, and we want this to be a really interesting discussion between me and Mohammed as well. But thanks very much for coming. Ahlan wa sahlan wa masa'al khair. And I am Michael Pollock from GoodCorporation. We're going to be talking today about the importance of robust due diligence. But first of all, I need to give you a bit of background about who we are and why GoodCorporation are qualified to talk about this. We've been working, as you can see, in the area of ethics and compliance for the past 2 decades, since the start of the millennium. And in that time, we've done around 600 projects, which are usually based on assessing and advising companies in the area of ethics and compliance. That's given us a lot of data, and from that data, especially in the area of bribery and corruption, in an area in which we've conducted over 100 assessments, we're going to be extracting some of the key findings today so that you guys can benefit from that, finding out where companies tend to go wrong, finding out examples of best practice, and making sure that as participants in this webinar, you can stay ahead of the game when it comes to bribery and corruption in general, but in this session, due diligence in particular. So I thought we should talk a bit first about the way the regulatory landscape looks on this. So we've had for a while now laws in place in the US and in the UK which have put requirements on businesses to do more in the area of anti-bribery and corruption. That's been strengthened recently by the introduction of new laws in France. And what is common about these laws is that they emphasize a risk-based approach, but crucially, they emphasize robust due diligence. So the topics we're going to be talking about today are common to a lot of the different requirements in a lot of the different jurisdictions in which your companies may be operating. And the effect of this is increasing pressure, obviously, increasing investment to make sure that companies get this right, but crucially, an increasing sense that companies want to do the right thing. And that's all very well and good if you're a company that's self-contained and you don't work with any other partners, but that's not the way business works, is it? We're always working with third parties, we're always working with other people. And when it comes to bribery and corruption risk, the crucial thing is that we can't outsource that risk to other people. We can be held liable for their actions, and most things go wrong when other people are acting on our behalf. So a lot of the DOJ investigations that we've looked at involve the alleged payment of bribes by third parties. So understanding third parties is crucial. And in terms of how we develop our research, so it's all based on a framework of good practices. And we've been assessing companies against our framework of good practices in bribery and corruption for the last 10 years. And based on these different areas, which include due diligence, we give companies a grade. And once we've given companies a grade in these different areas, we can start to show how companies look in terms of, this is a way of doing enhanced due diligence compared with each other. And so this is how our data looks over the 100 companies that we've assessed in the area of bribery and corruption. This comes from our recent research paper on the subject. And you can see there's a huge difference between certain companies there at the top, which seem to be doing everything correctly, and certain companies over to the right-hand side of the chart that are doing the majority of things wrong. And it's the way they do things wrong that I want to focus on today, because that's how we can help ourselves to stay ahead of the game. So the requirements are quite well known. A lot of the areas where the legislation converges is on the area of risk. So making sure that the riskiest suppliers are clearly identified. But then crucially, assessing those companies based on what you know about them. So tailored assessments based on what they do for you, and where they are, for example. And then the whole process, the whole due diligence process, should be proportionate and reasonable in light of what we know about that company. And so there's some examples on the slide here of the checklist. Was the third party recommended by a client or a public official? Are they doing sales for us, for example? Are they doing things like customs clearance or freight forwarding? There are simple things we can do to check, and those are part of the key requirements of the law and of best practice in this area. This shows some of the stuff that we look for when we do our assessments in the area of due diligence. And as you can imagine, we first of all look quite closely at whether the company has a due diligence procedure in place, whether there are clear procedures to follow up on due diligence and follow up on the risks that they've identified. But also, crucially, it's risk-based. So the highest risk suppliers or third parties receive the most attention in comparison with the lowest risk suppliers or third parties. And so this is the juicy bit, really. This is what the data shows from all our assessments over the past 10, 20 years in the area of anti-bribery and corruption. And what you're seeing on the slide here is areas where things have gone wrong, areas where things have gone wrong quite badly. Everything in green is the level of inadequate procedures that we have seen. So high percentages on this slide are a bad thing. And I just want to pick up, before I finish, on some of the areas of these data, of these statistics, and bring them to life a little bit. So the statistic you can see there on systems for deciding when to do due diligence, that's 53% of the companies we assessed did not get this right. Their procedures were inadequate in this area. And one of the most common problems that we've noticed with the companies we work with is that they're trying to conduct the same level of due diligence on every single third party that they have, which is unhelpful, and it doesn't get you very far. If you're working with a charity shop in Sweden, they require perhaps less due diligence, less attention than if you're working with a mining contractor in Venezuela, for example. And I can think of at least 2 companies we've worked with in France and the UK who came to us because they were just trying to do too much, and they couldn't cope with the amount of due diligence they were trying to do because they didn't have those systems in place to filter out the lowest risk companies, to filter out the Swedish charity shops that didn't require so much attention. The first sensible step is to determine that level of risk posed by each third party. And that's where things like World Check can come into their own and can be really useful for doing that initial screening. The second area where companies often go wrong that I want to pick up on is what you can see here where it says due diligence systems properly applied. And the most important thing that we find is that you don't get lost in paperwork and you remember why we are doing this. The idea of due diligence should be for us to decide who we want to work with and who we want to exclude. And some of the companies that we've worked with over the years have lost sight of that because they think the idea of due diligence is to produce as much paperwork as possible on every single potential supplier. And so some companies end up with mountains and mountains of paperwork, but every third party gets accepted because that's all it is. It's just paperwork. It doesn't have the procedures in place to exclude higher risk contractors and suppliers. And one example we have from this is it was a client in Mozambique, actually, and they had so much due diligence in paperwork, so many checklists, due diligence reports, and questionnaires, etc. And it was all just piled up in the office, and somebody had written on one of these questionnaires, "This is a very corrupt company," in capital letters in bold, and then just put the questionnaire back on the pile and continued to work with that supplier. Whoever wrote that was just so sick of the system that was in place at this company in Mozambique, where they were doing tons of paperwork on every supplier, but everybody was getting through, nobody was being excluded. It's crucial that we do implement our due diligence procedures beyond just paperwork. And the last point I want to pick out on this slide is that point where it says processes to manage high-risk entities. Because as you can see, only 48% of the companies we assess do this right. We've got over half of companies who have inadequate procedures in the area of managing those high-risk entities. And I was reading a great market research report recently on the area of due diligence, which said The future of due diligence is monitoring, and companies will be managing their relationships with third parties in real time now, rather than relying on historical information, rather than relying on a report or a questionnaire that was filled out 5 years ago. We're going to be doing a lot more to work with the highest risk suppliers to mitigate the risks that we know exist. And this is one of the areas of best practice that we have seen in our assessment work. The companies that do this right, they don't simply produce a questionnaire or a report and then put it in a filing cabinet and forget about it for the next 5 years while they work with that supplier. The best companies use the information that they get to develop a contract management plan for that third party based on risk. And we've worked with a company that actually developed a menu of options that they could use to mitigate risks posed by a third party, depending on the level of risk that they posed. So the menu included things like training, monitoring, auditing, additional contract clauses for these suppliers based on the level of risk. And if, God forbid, that company ever ended up in front of a court or being investigated, showing that they've done that, showing that they've engaged with suppliers to train them or audit them or monitor them, will mean a lot more to the authorities than just saying, oh, we did our questionnaire 5 years ago, or we did our due diligence report 5 years ago. Actively engaging with suppliers to mitigate risk is, we think, the future of due diligence. It's an essential second part of due diligence. So this slide simply shows that things aren't getting better very quickly. So this compares our 2014 data with our 2019 data. And as you can see, the companies in the bottom quartile in 2014, that's the bottom green, they still have many inadequate procedures in place. That's only gone up by about 11%. And they're still a long way from the companies in the top quartile. So those companies in grey and light green there. So this shows that although companies are getting better because more people are talking about it the way we're talking about it today, in terms of due diligence, there's still a huge gap between the companies that are doing this right and the companies that are doing this wrong. And what we're going to try and discuss today is the ways that you can do this right. So I'm going to leave you in terms of this initial presentation with 3 key considerations and 3 key takeaways for you guys as attendees of this Perl Initiative webinar. Key considerations: consider that increased pressure. So this is not just about the law, this is about more people demanding high standards in this area. And it's not just about prosecution, it's about reputational risks as well. And when we think about reputational risks, these cannot be outsourced to third parties. The people we interact with are as much a part of our business as anything else. And we need to make sure they are doing the right things and we are mitigating any risks that they pose. Key takeaways comes back to that sensible risk-based approach. So separating the Swedish charity shops from the Venezuelan gold miners. Make sure that everything we do with these third parties is based on risk. So that way you can take a tailored approach. Secondly, don't get lost in the paperwork. Let's remember why we are doing this. We are doing this to protect ourselves and others. We are not doing this to produce as much paperwork as possible. And thirdly and finally, remember that when it comes to mitigating our risk, this doesn't end with the onboarding process. We don't tick a box and assume that they're going to be fine forever. The crucial thing is that we engage with third parties, and based on what we know from our due diligence, we use that menu of options to mitigate the potential risks that they pose. Because if, God forbid, we ever end up being investigated or front of the courts, that kind of engagement is what matters, and it matters a lot more than a simple piece of paper. So I'm going to move on now to talk to Mohammed, because you know, it's going to be possibly one of the most exciting parts of this webinar. And I'm going to start, Mohammed, by trying to transition away from the US and European centered legislation that came up in that presentation, because these laws don't just affect the US and Europe, right? I mean, can you tell us a bit about your experience in this region and how these laws and these requirements have affected companies in this area?
Yeah, thanks, Michael. It was very comprehensive presentation, and you touch on key point that we are seeing in the market, whether in Middle East or other emerging market. First thing, I think one of the key element or the key takeaway I will say is your recommendation on the risk-based approach. People do not understand how it's a nice tools, it's a very good tools, but moreover, it is not the recommendation of you or your company or my company. It is part of the requirement of the regulation. The FATF say anytime they are accessing to doing audit, or when your correspondent, if you are a financial institution, or your auditor, when they are asking you whether you are doing randomly this type of due diligence, or you are having a strategy, they immediately sense the maturity of your due diligence. Because if you have a 10,000 clients, how could you do, as you say, how could you monitor 10,000 clients or suppliers? Okay, you need to do that by high jurisdiction. You need to do that by what is the highest risk. This is the one. The second takeaway I will say is the emphasis on, listen, it is not a ticking box process. The effectiveness of this is absolutely a milestone. And you know what? The FATF and the different regulators, when they are assessing people, countries, and companies, they are focusing on the effectiveness. Before, most of the focus was on the technical side of it, which is, do you have legislation? Do you have regulation? Have you implemented some type of policies? Do you have some framework? Yeah, and people were satisfied with that. Today, no. The evaluation, at least in some of the sector, was in the effectiveness. So again, the audience might say, oh, Mohammed Dawood is talking about the FATF, which is the Financial Action Task Force. I'm talking about regulation. I'm sorry, I'm talking about the regulation that through the UN, which is the UN resolution voted in 2001, it's not yesterday, every country have this part of their legislation. So when we are talking about Middle East or MENA, Middle East and Africa, every country has that part of their legislation. And every country has been mandated, corporate and financial institution, to go and to implement this type of framework. And it's not only drafting policies, it is drafting a real framework, is helping, and this is, I think, a very big added value I see what you are doing, is coaching a corporate or coaching an organization to understand what matter, how to do it, what is the best way to focus on your highest risk. And as you say, this type of risk, you cannot transfer it. You were talking about outsourcing. You cannot transfer it. In fact, more you will be talking about the way you are not handling this risk to your counterparty or any third party, more the risk will increase. So the problem that you are having is either you have to do it effectively or not. There is a lot of, many people do not realize that many governments have did a national risk assessment. And in the national risk assessment, please ask it to your authority, Ministry of Commerce, central banks, authority, they have this. And they are obliged from an international regulation to have the national risk assessment. And what is the national risk assessment saying? Okay, what are the main business in the country? If the main business is holidays and tourism, then we need to assess what are the risks and what are the due diligence related to this sector. If in the country, one of the main business is real estate, then we need to check what are in the real estate business that are risky. If the business is gold and stone, which is selling the wholesale and the big market, then we need to focus on this market and to do the risk-based approach on this market. As you say, you are not going to start doing a due diligence on somebody coming and buying a ring for his fiance. You are going to focus on those wholesale, importer, exporter of gold, or precious metal. So it makes sense when we are when addressing this type of third-party risk and the due diligence and the concept of KYC in the financial sector. It's a key today. Is frankly a key element to benchmark if a company, if it makes sense to work with this company or to not work with this company. So I am seeing that now. We might have to perception, and one of the questions I was going to ask you is, we have a lot of perception in the region that this is UK, this is Sweden, you are talking about, this is very sophisticated, developed country or OECD. How this apply to our region, and how do we have an impact as a company operating here in the Gulf? Your experience.
Well, I think that's a really interesting question, because what I've learned over the past few years working with GoodCorporation is that when we come to talk about businesses, we're very rarely talking about businesses within countries that only abide by the laws which apply in that country. Increasingly, what we're seeing is businesses developing their own standards, developing their own codes of conduct, principles, anti-bribery and corruption policies, which it doesn't matter if that company is headquartered in Paris or Frankfurt or some beautifully pristine air-conditioned office in Belgium. It matters where that company does business. And so the companies that we work for are usually large European multinationals, and they're doing business not just in Europe, but in parts of the world where it's very difficult to uphold the kind of standards that they would want to abide by. And so what I realized is that when it comes to business, there's no kind of sense of we're here, so therefore we do things, according to this country. What we do is help companies to make sure that the principles that they want to use and the codes of conduct that they want to use and the anti-bribery and corruption policies are applied the same, whether it's in Paris or if it's in Qatar or in Congo, etc. And so that causes a lot of difficulty, because we can't go into these countries and say, excuse me, I've got the code of conduct of your corporate entity here. I think you'll find you're supposed to be doing this, this, and this. We have to be quite nuanced and sensitive in our assessment work to try and help these companies to do what they can in light of the situations where they are. And so we would never ask a company to break the law, but we would usually ask a company to abide by the law in a way which meets the standards of their parent organization. But it can get very interesting, Mohammed, to be honest. It can get very difficult.
Yeah, when you mentioned the large corporate, and we understand that they are widely implemented, they have to care about their image, their reputation. What about the experience of first thing, small corporate in the region and financial sector? Because I noticed that the financial sector sometimes they have tendency to think they have some types of policy, but in the reality, most of the time, it is it is drawn in a policy on the procedure, a vague policy on the procedure. This one. The second thing, we have a lot of corporate in the region. They think this is not for them. You are talking about Coca-Cola, Google, Thomson Reuters, this IBM. But me, I am just a small, medium pharmaceutical distributor of medicine in the region, or I am only, a medium factory in, and why it apply to me?
Well, that's a really interesting point, because we went through the same thought process about 5 years ago, and we realized that we were mainly working with big companies, but there must be small companies, the kind of small companies that would work with the bigger companies and be subject to their due diligence, for example, who would need all of the same things and who would be affected by the same kind of standards, especially when it comes to due diligence. And so the way we approached it is, instead of offering to go and assess them for 2 weeks at their own expense, we developed a set of tools that they can use. I mean, we called it the compliance toolkit, and it's designed especially for small businesses that don't have big budgets to do big things, but need the basics. And so we've used it a lot to give people, you know, our bribery and corruption policy, our anti-money laundering policy, our due diligence questionnaire. And it helps us to help those companies who are a lot smaller than the companies we would usually deal with. But your question comes back nicely to the due diligence area, because the reason these smaller companies need that kind of thing is because they're always being assessed by much bigger companies that they want to work for. And so everybody is incentivized to get due diligence right, whether you're the big company performing due diligence on smaller companies, or the smaller company that's being subject to this kind of thing. It's in everybody's interest to do this right. And I mean, in terms of the financial sector, like, a lot of our work has been with, for example, banks who want to perform assessments on the companies that they are going to be investing in, for example. And so you could call it a type of enhanced due diligence, because we go there and we spend 2 weeks on the ground, face to face with that company. Show me this policy, show me this system, tell me how this works in practice. And that is our financial sector experience, to be honest, at the moment, is that we feed that information back to the bank as part of a condition for the loan, for example. But I know that you, Mohammed, have a lot of experience in the financial sector, and I'd be interested to know how you've seen these issues develop over the years, the due diligence issues that we've been talking about. Have banks been doing this for a long time? Have banks only just got the message on this?
No, it's reverse. The bank is doing, the large bank at least, but most of the bank, they are doing this a long time for one reason. And I think the same probably phenomenon will happen, and is happening in the corporate space. So just to summarize, in the region, the corporate space is weak in due diligence. Okay, really weak. Okay, the banks, I tell you why. When the initial, this is story around it, when the initial circular and mandatory requirement came from the different regulators, and specifically central banks, to the bank in the region to apply anti-money laundering and anti-terrorist finance policy, KYC, due diligence and everything, guess what? Surprisingly, I remember, I'm talking about more than 18 years ago, just after the 9/11 and the famous USA Patriot Act and the famous FATF and everything. So I was surprised. I went to the bank and I started saying, what are you going to do? And they looked to me and say, are you talking about these international regulation things? Yes. To spy on our customer and our supplier? Yeah. It will never work in the region. We will not simply apply it. And I was surprised, because I remember having a circular from one of the central bank, and I'm not talking about small exotic country. I'm talking about big GCC country. And they're saying, but this is a central bank. And they say, oh, we know, but it's mainly some type of political pressure and so on. And the same people, the same banks I talked to, I was in the first meeting when I was open this subject, they hardly listened to me. And in fact, they took it as the arrogancy of the international regulators. A few weeks later, 4 weeks exactly, the same banks call me in emergency, because they have to do a board meeting to talk about this subject to their to their executive management, and they needed some expertise. And I was surprised, saying, but you told me 3 or 4 weeks ago that you will never implement this policy. And they told me, yes, but meantime, the things has changed. And I asked, I will only open my mouth once I know what has changed, because I saw a regulator sending you a mandate, you don't do it, and now and I realized that it was the counterparty. So the international banks send the questionnaire, the famous Wolfsberg questionnaire, or the KYC questionnaire, or the due diligence questionnaire that you were talking about, big company doing, and they told them, you can please confirm that you will be applying this policy, you will be hiring people, you will be hiring assistants to do your framework, because they have no idea how to develop the framework of anti-bribery, anti-corruption conflict of interest or anti-money laundering, that you are going to put a system in place. Failing to respond with the signature of the director, your dollar account or your euro account or your European, any foreign currency account will be closed. So the bank starts realizing that in order to survive in the business, they have to apply. And guess what? It's exactly what the bank are doing now. The bank are now assessing a company and sending to those companies those same questionnaire and telling them, are you complying with the ethic? Yeah, are you complying with the policy? Do you have any corrupted business things? Because otherwise I have to close not your dollar account, your local account. And I can tell you that, and you can find it in the Arab Monetary Fund reports, 200,000 SMEs and companies account in a local currency in MENA has been closed last 2 years. So when you see a big players, as you say, subcontracting, now if they have to subcontract or distributor, they have to check if they have the policy and if they are aware of the policy. So what you are preaching is a very, very important in the corporate sector in the region.
And it sounds like there is therefore a movement. It sounds like things are really working. If what you're saying about thousands of accounts being closed of SMEs because of everything you've described, it sounds like there's a bit of forward momentum now, and people are starting to really care about these things, and people are starting to take due diligence seriously. Is that your impression as well?
Yes, but they don't know how to do it. They don't know where to start and to finish. They confuse the process. They confuse the policy and procedure with the framework. Sorry, they confuse the operational procedure with the policy and the framework. You know, you cannot define the operational procedure if you didn't define what is the framework.
Yeah.
How could you say to somebody, you don't need, you know what, you have to be very careful about gift, and because it could be assessed or perceived as bribery. If you didn't define what does mean bribery or gift policy, you can't. Otherwise, you are telling me what to apply my goodwill or my good understanding to understand that a pen of $10,000 or a pen of $100 is the same. Like you were saying, we need to define what are the policies. So I am saying that there is a very serious weakness in the region about understanding, and we are sometimes it's not shy. We have the arrogancy sometimes, excuse me the word, or the perception that we can do it ourselves, while we need to learn. So the problem here is by doing observe, as you say, how can I benchmark myself with the others? You were talking about benchmark. You were saying, in fact, your study is a benchmark study. When you are coming to a specific sector, you already are benchmarking with the other sector, and you can say, you know what, you are in here. This is the as is situation where you are, and this is where to be situation where you are, and we can take you, and we can take your hands and go, because it is a new concept. You need to go from coaching. It's a melee of coaching and mentoring, how to get there. And this is what the people in the region need to do. And this is what I think, I'm telling you, my opinion, a service like what GoodCorporation are having, it's a blessing, because we have a books of regulation. We have a books of policies. We have a book of central banks or regulators requirement. How to effectively deploy it, the recipe, how to do that, it's not always obvious. And it is not obvious because it's a new concept.
Yeah, and I think so. In terms of our recipe, that the framework is the recipe, and I know you like the framework. This is how we do it, and it's only because we have a standard framework like this that we use for every company that we can produce data like that, where, you know, on the basis of face-to-face, on the ground work with these companies, we can benchmark them all against the same standards and see who's better than others.
I am checking if there is any question of the chat. I don't see any.
Well, we have some questions which have come through, which I think we can go to now. So I can see some questions here. But before we go on to that, Mohammed, I wanted to use the next couple of minutes just to ask you one more question from my side, because one thing we haven't talked about, which everybody is talking about right now, is the ESG factor.
Yeah,
right?
yes,
So,
yes.
So we're hearing more and more these days about the role of ESG data in assessing a company's ethical performance. Now, what we're looking at on the screen here is not ESG data, it's anti-bribery and corruption data, but it would be part of that bigger picture of ESG and of ESG metrics that are, we think, likely to affect our understanding of due diligence in the future. But is that your impression as well? How do you think the ESG factor is going to affect due diligence? And maybe you could just explain to the audience what we're talking about when we talk about ESG.
Okay. So when we are talking about ESG, we are talking about environmental, social, and governance, or in more broader way, good governance, or the corporate social responsibility of a company. Okay. So what we are seeing in the financial sector, before, an investor will only care about profit. And after the financial crisis of 2008, we realized that there was a lot of financial crime and the rogue investor and everything. So the regulation and the community and the start cleaning up a little bit by saying, okay, guys, we need to make sure that when there is an investment and when there is a finance, we have to follow some ethical. And this is where you were talking about UK Bribery Act that has been enacted in 2010, where introduced this concept of conflict of interest and ethical. Now, the problem is the same thing. What do you mean by ethical? Is it if I am ethical, I am an ethical guy, but I will be investing in a factory that will be sewing half of the water or half of the rivers? Is it a good investment? Is it? I am still ethical as a company, but what I am doing, I am touching an environment, and this environment, this means that I am touching people. Okay, the same thing when we are talking about diversity or biodiversity. So is it, now we are having this, it is, in fact, I can tell you, which is a very good question, because it has been, frankly, been in the discussion for a while, and the COVID situation make it, the emphasis make on the COVID, because we start asking ourselves, are we ourselves a virus on this earth? Are we ourselves impacting our earth? Are we impacting our earth and our community? Because in the reality, what's happened is the virus is not only impacting us, it's impacting the whole community. So what is the meaning, what we are doing in this earth? Are we safeguarding our climate, our earth? Are we? And then the people start taking more conscience and awareness of, maybe now, when I'm going to do the next investment, in addition to ethical, in addition to good governance, I will take care about some additional factor as a risk or as an element, which are environmental, social, and governance. And specifically, we are talking about corporate social responsibility, which means that should I just invest in the big factory and put 2,000 people layoff because I'm going to make more money, I'm going to buy a yacht, and I will be in the most in Facebook magazine things? Or should I consider doing this investment elsewhere, where it will give back to my community and my social environment? So ESG is becoming a very key factor. Now the problem is Refinitiv, my company, we are having specialized people talking about how to benchmark it. You were talking about how to benchmark it, the ESG component. Okay, is it carbon print? Is it something else? Okay, and there is a lot of discussion. So you will be seeing a lot of debate and I'm guessing the policies, the frameworks integrating the ESG as part of the component of the anti-bribery and anti-corruption and ethical policy, because saying ethical is not enough. We need to define what are the components of this ethical.
Exactly, and that's what we've been trying to do for 20 years in our case. Just take that broad concept. I mean, we call it business ethics today. It's been called corporate responsibility, corporate social responsibility. Trying to take that quite broad concept and turn it into something where you can really measure it has been part of our work for a long time. And what we've seen with the emergence of ESG is more focus on that kind of metrics piece, that the idea that people want data about this stuff. They don't just want to have the idea of ethics and compliance, etc., as a kind of a vague concept. They want to really know what it means, and they want measurements, and they want data. And that's going to become even more important in the area of due diligence, our topic for today, because as we shift more towards graphics and charts and numbers like this, companies are going to have to be a lot more sensitive about how they look, how they're presented, how they look to the public, but crucially how they look to companies that might want to work with them, companies that are assessing them on a due diligence basis. ESG is definitely going to be a really interesting area for all the topics we've talked about today.
Yes, and it will be magnified by the digitalization of the business that we are seeing after the COVID. The COVID is pushing us to do a lot of digitalization, the digitalization of the financial services for the financial sector, the digitalization of procurement for the corporate space, digitalization of interaction with the consumer. So the digitalization is going to amplify this, because today we are talking about social media, and between you and me, there is a huge number of population. They don't access to the social media, or their access is limited. Remember, we are 7 billion human beings. So this digitalization is going to magnify the principle of, and the people will be more awareness. So you cannot hide. You simply cannot hide. And it will be like a systemic risk, which is, if I am implementing a policy to myself as a corporate for due diligence and ethic and the anti-corruption program and ESG, well, I will not accept to deal with the counterparty that don't have the same principle. Okay, they have to, otherwise they are not part of my club. And we are a connected world, and I guess I believe this is where we are going. I am sure that ESG in the next 2, 3, 4, 5 years will be a milestone in moving forward with any relationship.
Yeah, and so you're touching on some issues here which are coming through from the audience in their questions, and it'd be really interesting to bring up some of these questions now from the audience as we come towards the end. So one of the questions we had was about the spread of COVID-19, which you've talked about just now, and whether we think this is going to affect the practice of conducting due diligence on third parties. And what we found, certainly just from our point of view, is that it's affected things in a couple of ways. One is that with so many companies struggling just to survive because of the economic impact of the virus, things like due diligence, sadly, are, even in the financial sector, becoming slightly less important. Everybody's just trying to make it to the end of the quarter, make it to the end of the year. And so key things about ethics and compliance, like we've been talking about today, people have been thinking, I'll worry about that tomorrow. And the second thing that's affected, as far as we can see, is so much of our work is face-to-face. So much of our work is about getting under the skin of the culture of an organization by going and spending 2 weeks living with them, basically. That's the kind of enhanced due diligence that we would do for our clients. And we can't do that right now. We can't travel. We can't, I'm sat here in London in my office at home, where I've been sat for the past 5 months. I haven't really moved. But usually my job involves this, like your job, Mohammed, it involves going around, shaking hands with people, talking to people for an hour at a time for days on end. And our ability to do that kind of due diligence work has been affected in quite a big way. So we, have had to adapt. And I think the whole area of due diligence has had to adapt, because we're doing a lot more of this kind of thing, talking to a computer screen, sitting at home and doing these assessments by interviewing people from our offices. So it's definitely affected us in that way. But did you have any other thoughts, Mohammed, about how COVID is going to affect due diligence the way we've talked about?
We saw a lot of, when I told you about digitalization, we saw a huge increase of example, digital onboarding of customers, okay? And it's before the digitalization of onboarding customers, which means that we don't need to have a customer coming to the branch, we can't. So by reading his ID or his passport, by doing some biometrics checking, validation, by sending some automatic question about KYC question that you were talking about, the due diligence question, we can have some kind of profile and we can onboard the customer. We saw this really happening in the example in the financial sector, in the retail, which is the individual interacting with them, and there are very fine fintech thinking to do that at the corporate level. We saw also a lot of what we call through processing API, where we are checking sanction database. You were talking about WorldCheck. Today, we are mainly selling an interface to WorldCheck to screen automatically, because we cannot do any manual screening. So we have to go to the database. But you were saying yourself as a policy, your job and my job has been affected. And frankly, we as a Refinitiv, we decide that part of our corporate responsibilities, we are doing a lot of things in compliance, because we are specialized in anti-money laundering, anti-terrorist finance. We have this biggest database with the people don't do business with. So what we decide to have the team focusing on coaching and mentoring the community. So because as you say, implementing a tools without a minimum training and mentoring, it's not going to happen. So yes, but definitively, I agree with you. That has a serious impact in the way, as you say, there are some, it's like e-learning. There are some concepts that you can do through computer e-learning by enforcing a message, but this message needs to be discussed face-to-face. The concept need to be sometimes face-to-face. We will have to adapt, but let me just tell you, any company who will ignore, or in my opinion, think they can do it without, which means that they will forget the due diligence, the framework, and not doing, they are mistaken, because it will fire back seriously. If I am one of these companies listening to us, and I have only one advice to give, is don't implement tools, implement policy, engage. There is a lot of things that can be done remotely. Learn, implement, get assistance to understand what is it. And therefore, when the tools is going to come, you will be ready. It is a very good opportunity to do that, because we have more brain time to give to, education and improving our understanding of this world. And also understanding how we get in this situation, because we provoke this situation, by the way. It's not the earth, it's not the nature, we did it.
Well, it comes back to your point before about, are we the virus? Are we the virus that's affecting the world? And I think if there's one quote from this webinar that's going to stick with me, then it's the "Are we the virus?" question. If we don't put that on Twitter, then nobody, we're making a big mistake, because everybody will want to watch this webinar if they know we talked about the question of, are we the virus? And that the question you raised about training is a really interesting one, because when I talked about the menu of options that our clients use to handle their third parties after they've done due diligence, training was on there, and training is a really big one. If you decide that you want to do training for your third parties about your anti-bribery and corruption standards, for example, or your general ethical standards, it's a great thing to be able to do and to be able to show that you can do, because it means so much more than sending them a document that says, here are our policies, here are our standards, please abide by these. If you're training, then you're engaging. And I think people have thought at the beginning of lockdown, at the beginning of the virus, that training was kind of over and there was going to be no more consultants flying across the world to go and spend a half a day training people in the middle of nowhere. But what we found in our own experience is that a lot more people are asking us for e-learning. You talked about e-learning. A lot more people are asking us for remote training, where we talk at a computer screen like this. And a lot more people are asking us for webinars, so to do this kind of thing. And I think it's great, because I think it shows that even when we're not flying around the world and increasing our carbon footprint, by the way, even when we're not doing that, we can still engage. And it comes back to one of the key points I tried to raise towards the end of the presentation, which is about, it's not just about onboarding and then forgetting, it's about engaging. And we've learned new ways to do that during the virus, which I think will probably take with us long after the virus is gone.
Yes, and I would like to make a little, how to say, nuances, just to take what you are saying, between training and engaging. I can train somebody tomorrow on what he's doing because he understands the concept. So I used to say for banking, I can train somebody on treasury. He understands treasury, so I can train him. I can train somebody to drive because he understands how to drive, and then I'm just showing him in the new car. He understands what does mean driving. Now, imagine that I'm talking to somebody who never saw any vehicle in his world. He don't even know what does mean bicycle. I cannot train him driving. I need to engage him in a coaching to understand what does mean a vehicle, how it works, what is why, what is it, how, what is the rules of this vehicle, what are the conditions, and then once he understands what this vehicle means, I can train him on driving. So I'm talking about GoodCorporation opportunity here is not to train people how to apply policy and procedure. No, you need to train how to understand what is behind these policies, what is the mission, what is the principle behind. And this is a very important because frankly, people start understanding what does mean basic due diligence, but they confuse. For them, due diligence is when they have to give their ID to open an account in the bank. Oh, no, this is just one of the process. Oh, really? No. So what is KYC? It is also due diligence. Excuse me, I'm getting confused. So the people need to understand where to start, where to finish, and why, the principle behind it. Without we are human. Without understanding the principle of a framework, we don't apply the framework. We cannot install it. You can send any training. You can tomorrow develop a very nice anti-bribery, anti-corruption, ethical framework document, send it to somebody, and he will get it, and he cannot do anything with it.
Yeah, and that's why we like doing things like this, where we don't just send training to people. We look at them face to face, and we like doing training in this way. You know, we very rarely, I mean, we never develop training and just send it to people. This is what we do.
You say the word. You say engaging.
Exactly.
Engaging. Yeah.
Exactly. And I think that level of engagement sort of comes back to the three key areas I tried to emphasize at the end of the presentation, because it's not just about the onboarding process. I mean, in the onboarding process, you might send them a training document or a link to some information. It's not just about that. It's about, as you've said, Mohammed, it's about engagement, and it's about monitoring and working with these third parties over time, because that's what really matters in the end. And as you know, the other key things were, let's be sensible about this. Let's take a risk-based approach. Let's not get lost in the paperwork. Let's remember the meaning of this. Let's remember why we're doing this, to protect ourselves and protect others. And crucially, as I've said, it doesn't end with the onboarding process. As you've said, Mohammed, it's all about engagement. And I think that brings us to the hour. And
yes.
Yasmin is not with us, so I've been asked to do the final comments here. But basically, what we've said on the slide there, the way we've wrapped it up is the key takeaways we'd like to give you guys as participants in this webinar. Mohammed, is there anything else you'd like to add before we say thank you?
No, I just I hope they got the message that it is a very important element in their business and the way they do their life. And I hope we will have I hope this session help them to grasp and to understand what are we talking about, and especially how this is evolving in the future.
Exactly. And so in terms of the future, then looking to the future, we're going to be doing one of these sessions a week. I hope that Mohammed will come back and do more with us. But next week, we're going to be talking about risk assessment. That's happening next Wednesday. And everybody that's been involved in this webinar, thank you so much for your participation and your questions. You are all very much invited to that session next Wednesday, and we'll make sure we get the invitations out to you very soon. We look forward to carrying on these sessions with you and hopefully to completing this whole course of 8 sessions. So it only remains for me to say thanks very much for your participation today. We really appreciate it. And yes, we look forward to seeing you again. And so thanks very much, Mohammed, and thank you everybody else.
Pleasure. Thank you very much, and thanks to Perl Initiative who took this initiative, which is a very good topics and subject. Thanks, Michael.
Great.
Thanks everybody.